Do you ever take a trade with a perfect draw on liquidity, perfect entry model and everything, but you get stopped out and then price pumps to your take profit? Even though you know that you took the trade too early, you most likely don't understand the why and also when and where you should have hopped into that trade to get an efficient trade that hits take profit in minutes. In today's video, I'm going to be combining all these ICT concepts into a simple framework that I like to call market fuel. This framework will tell you exactly where the market will speed up, encounter resistance, and maybe even reverse. And from this, we can figure out exactly where we want to take our trades. So let's hop on them charts. Before I teach you guys the concept, it is super important that I make sure you guys have a super basic understanding of the simple concept that will serve as a base to this market fuel concept. So let's draw out a quick trade setup, right? Say we're super bearish in the higher time frame, right? Price is a bigger time frame draw on liquidity all the way down here. And then what we see price start to do is maybe give us a slow, high resistant run to the upside to rebalance price up higher. Maybe we tap into some kind of fair value gap sitting right here. Maybe we make an SMT with this high, something along these lines, right? Maybe make an SMT right here. And then from there, we see displacement lower, pullback, entry for shorts, right? So our entry would be right here after the change of the state. We take our trade to this level and then we leave runners for the external level, right? That is a super simple trade setup. Even if it's not going to be some kind of fair value gap, it could have been a internal sweep of buy side up here. So drawing out buy side right here with an SMT, looking nice. And then maybe we swept a bigger time frame buy side level, maybe over here, right? So buy side right here. That is a simple understanding of every single trade setup is going to look something like this. Now the characteristics of this trade setup that are going to make it work out so well are within this one leg right here. This leg is a low resistant. This leg is a high resistant run to the upside that leaves behind stacked lows with every single pullback, right? So zoom up, right? This is going to be a high resistant run. So say we're pulling to a draw on liquidity, right? We're looking something like this. This is the market generating liquidity. You know, we usually do this sometime after hours or when we're setting up to have a trade setup, right? This could be a 1 minute time frame, and we're going to take a 1 minute internal model lower, something like that, right? Or this could be just an entire overnight session on a 15-minute time frame that's setting up for the New York session to give us an efficient move to the downside, right? This is generated liquidity. So when the market taps into the efficient zone that it wants to seek and then displaces lower, we're now within an area where there's no objects to price, right? Price can move lower very quickly because understand this. At this point, the buyers are in control, right? So there's more buy orders than sell orders, which is why price is moving higher, right? That's how the order book works. But understand that people taking positions on these levels, right? Institutions, algorithmic traders, whatever it might be, they are putting buy stops beneath this level because understand when you take a position, if you say I want to take a long, right? This right here is going to be a buy limit. This right here is going to be a sell limit because I want to sell and secure my take profit, right? Then down here is going to be a sell stop because I want to stop further losses, right? So I'm going to sell here, but I'm going to buy in my position here. So understand, this is a sell stop right here. So now apply that to this, right? At this point, once we've tapped into our efficient zone all the way up here at the highs, where we now think price and know price wants to act bearish, right? And we're thinking of framing a trade setup down to this low. Once we get to this point, now the sellers have taken control. The bears are in control over the bullish, right? So now understand that when the bears are in control, we can use all of these sell stops sitting beneath these lows as fuel. So now understand that when they take positions right here, what's right here is going to be a sell stop, right? And when the bears are now in control of pushing price to the downside, they can use all of these sell stops as fuel, as market fuel. Because think about this. The market moves higher when there's more buyers than sellers. The market moves lower when there's more sellers than buyers. So when we go down and with every push lower, we recruit more sellers. That tells us that we're getting more people into our side, into our army, and we're going to push price even faster to the downside because now there's no bullish obstacles. Every time the market moves lower, it gets more fuel to its run to the downside. That is a simple concept, and this works flipped upside down. This is a low resistance liquidity run. This works anywhere and everywhere in the market. So we know that this is what we want to trade. We want to trade this efficient move to the downside. Now let's draw out something completely different and we'll explain why you don't want to trade that. Say we have the same exact thing, right? We have price moving to the level in which we want to take a short off of, right? So price is moving like this. And then we get to that level and we do a turnaround and quick right here. Do I place my, price is right here, right? So do I place my short right here? And do we look for the short down at this level? I mean, the setup looks very similar, but there's one key difference. There is no generated liquidity in this leg, right? there's no sell stop sitting beneath anywhere, right? Maybe one right here, but the difference is that there's a fair value gap in this leg, because look at this displacement, look at that quickness in price, right? Fair value gap there, fair value gap here. If there's a sell stop here, what are people doing once price retraces into that fair value gap, right? There's going to be a ton of buyers, right? So why would I short into those buy orders? Why would I short right here when price is simply just retracing into a fair value gap to push higher, right? The price is going to push higher off of that. There's no point in me taking a short there, right? That's the concept that we need to understand. That's why we don't want to be trading in this, right? This is a potential break where price might tap into here and then stop, slow down, or reverse higher, right? That's what these fair value gaps can do, right? So we don't want to be trading these legs that look anything like this, where there's no generated liquidity and tons of stacked lows or stacked highs. We just want to be trading the things that look perfectly like this, where there's tons of stacked lows and we see efficient moves to the downside, because here we're going to see something like this. If price wants to move downwards, it's going to be doing something like this. It's going to tap us and it's going to slowly go like this, right? You will rarely ever see price do something where it taps lower, it goes like this, and then it taps on a level and then efficiently runs to the downside after making no generated liquidity right here. We need that generated liquidity as fuel, right? These levels, these fair value gaps, are objects to price sorting. These areas where we have tons of low resistance liquidity, these are helpers to price. These are allies to price. These are allies to our trade idea. So from understanding that, now we can look at these two and understand that this is not something we want to trade, and this is something that we want to trade, right? That's as simple as this gets. We have to understand those two concepts. Now we can look at this and say these areas are enemies to price. They're enemies to our efficient move to the downside, where these areas with stacked lows are going to be allies to it. Now, when we see a trade setup forming like this right now, we have a bigger time frame drawn liquidity that's lower of a super high time frame bearish trend, right? We see generated liquidity up to retrace into a fair value gap to push lower. The entire leg is not going to be perfect generated liquidity, right? So within this leg, let's dissect it, right? Where is going to be the imbalanced price action that is going to be the enemy to our run lower, where there's a quick move in one direction that leaves a fair value gap, right? We can assume that there's going to be a fair value gap right here. So this area is going to be an enemy to our run lower. Now right here, after that fair value gap, what do we have, right? We have nothing but stacked lows from this point to this point, right? So right here, this is going to be an ally to price. So let's mark that as green, right? So right here, now we have an enemy to our run lower and an ally to our run lower, right? Now let's continue. Right here, we have a little bit of an imbalance sitting here. This is going to be an enemy to our run lower. Then after that, what do we have? Nothing but stacked lows right here. This is going to be an ally to our run lower. Let's mark that out with green. Continuing lower, we have an imbalance, right? That's going to be an enemy to our run lower. Let's mark that out with red. And from there, we have nothing but stacked lows past that point, which is going to be green. After this, we have a little bit of a gray zone until we hit our higher time frame drawn liquidity, which we can just assume to be either or, right? Price could reverse after sweeping this level right here, and then it could also just run straight through it. So now zooming out, what did we just create? We just visualized areas in which price is going to speed up quickly and run efficiently to the downside, and areas where price could potentially slow down and maybe even reverse. So now looking at the trade idea, what is price likely going to do? It's going to run through all of these low resistance liquidity, and that's going to be our displacement, right? After seeing that, it might tap in that fair value gap and push higher, right? Generating more liquidity on the way up. After that, it might come back into inverse that fair value gap up here. Then we see displacement lower. We trade that internal model, and then we see efficient run until we hit that next fair value gap, right? From here, there's two things that can happen, right? Price can either slow down here, do a little bit of some kind of just accumulation, manipulation, then distribute lower, or this can be a reversal point for price, because now if we look, this is going to be at equilibrium of the range most of the time, and it's going to be an area in which price can reverse because this is a fair value gap, right? We have to understand these red areas are areas where price either slows down or reverses, right? So price at this point can either slow down and then continue lower to hit our take profit, hit our bigger time frame draw on liquidity, or price is going to reverse at these areas, right? This is a market maker buy model, then this is a market maker sell model. And together, these create a market maker model. This is perfect. This is a perfect display of what a market maker model looks like. And then we want to look at where price can slow down, right? So how do we want to trade this? I like to trade the internal model. So I would zoom in to get entered at this point and take my first take profit to this level down here, right? So most likely we'd be getting some kind of better RR, something like this, right? Where I'd be taking it to right here. And then we'd be getting this trade to the downside, right? Then I like to leave runners, right? I like to theme my runners around where I think price will go, right? So we hit this first internal level, right? That is confident draw on liquidity. That's my low hanging fruit. From there, I take 50% off and then go break even. After we hit this level, I'm confident that we're going to continue running through this fair value gap. And then once we've ran through that fair value gap, understand when price is at this point right here, it has nothing holding it back from going to this point. So I'm super confident that price is going to hit this point next. So after this take profit getting hit, my next take profit will be right here. From there, we can see price slow down or speed up, right? We don't know yet. So at this point, when I see price hit that level, it's either going to reverse and stop me out, or it's going to continue all the way through this fair value gap. And then once it continues through that fair value gap, I'm confident that we continue down to this level. So this becomes third and final take profit. And then from there, if you want to leave runners for the external draw, go ahead. That is how we need to trade this. We have to understand that the market moves like this and it encounters enemies along its way to the run to the downside, right? So we need to make sure that these enemies get taken out first before we can encounter a low resistant run. So in doing this, we need to make sure that we first invalidate order flow before understanding that these will all get ran through, right? We can be confident that the market is setting up to do this, but not know when it's going to go. And we can get faked out at any point along the way, taking a premature short. So you have to understand, once we see this first fair value gap get invalidated, right, get ran through, and then we see all of this low resistance liquidity get entered, that shows us that order flow is switched, right? We're now into bearish order flow. So now we can look to take a short and then bang all of this RR out. So let's find an actual example on the charts and I'll show you guys exactly what I'm talking about. All right, so zooming into Thursday's setup right here. At 8:30, we had news. So news goes ahead and puts in a 15-minute range right here. All we want to wait for is one side of this range to get swept and then potentially look for some kind of reversal, right? So exactly what happened, right? We see price slowly grind to the upside, run on 950 macro, it almost fakes us out, gets some people in early shorts, goes ahead, stops them out, and then it comes in and takes the side of the range, right? So now we're looking to see if we can potentially get some kind of reversal setup. I'm not predicting it, I'm not pre-firing it, but I'm just waiting to see, can I get my setup, right? So we tap into the high time for value gap, right? And then in this leg right here, let's go ahead and remove this. We see imbalance get put in, right? So 1 minute imbalance get put in. From here to here is pretty much our imbalance price action zone, right? Price runs through that. After that, what is left? We see nothing but stacked lows to this point, right? And then from there, we see, so let's mark this out as green. So then from there, if we zoom out to a 5 minute, we see a fair value gap right here. So let's mark this out as red because this is an enemy to price. Now, if we zoom out to maybe the 15 minute, we can find out where maybe the higher time frame imbalance is resting. So if we look right here, we have a 15-minute imbalance sitting right here, right? So we can mark this out as two separate ones, or we can just group them together as one, which is exactly what I'll do, right? This is an area of imbalanced price action. Let's zoom to the 1 minute and then find how price reacts on this level, right? Once we tap into this area, where there's not a lot of stacked lows, right? We have imbalanced price action. Price is moving quickly through this area. We see a slowdown and we see a super lethargic move, right? From here, there is nothing, after we run through this level right here, we use it as inverse. And then from there is no reason price should move any higher because look, there is nothing holding price back. Stacked lows all throughout this area. Look, that's fuel for the market. Tons of stacked lows, literally equal lows right here. This is all fuel for the market, right? Now zooming lower, what do we have after that? We have complete imbalanced price action. Let's look at a 15-minute. I bet you there's a huge fair value gap right here. Beautiful. There's a 15-minute fair value gap sitting right here. So this becomes an enemy to price. So once we zoom into this area, we can expect to see price either slow down or turn around from here. So once price taps into that level, it starts slowing down and then it reverses, right? It comes up, we put in a high, right? We come lower and then we make an SMT on this level. And from here, this would have been your long entry. If you were looking to trade a long today, you could have waited for change the state delivery, then entered off of that, something like this, right? It's change the state, entered, look for that internal high. Stuff was really nice. And then maybe if you want to look for this, you most likely wouldn't have got it. Yeah, and you would have got stopped out. When we're taking this short, we need to understand price like that. And we can do the same exact thing for the long side. So how would you have traded this? For me, this would have traded best at just a simple 1 minute model, right? So I'm just waiting for this first fair value gap to get inverse, right? Note we're around 1050, so 1050 macro opens up. I want to see inverse fair value gap and change the state, right? Change the state is on this level, inverse fair value gap right there. So after I see change the state delivery with displacement, I want to place my order right there at that level, stop at that high, and then I just want to look for whatever my area would be, right? So you could take a first take profit at this level if you were like that. For me, my first take profit was at this low because it was super achievable. But looking back on it, there's no reason, if price is going to hit this low, there is no reason that price shouldn't go ahead and hit this low. So this could have been really your first take profit right here. And then from there, price should have just ran to here. Because if we invalidate this fair value gap, we now have nothing but stacked lows holding us back through this point, right? So this becomes green. This is how we need to look at this, right? It goes from red to green to red to green. This is how price works. If we can get involved here, which if you look, price doesn't actually tap the order, it just kind of edges it and then dumps. So no problem, we didn't get tapped, but this model is still valid. If we look, price slows down or reverses at every time it taps that red, because that's how imbalances work. But the green areas are where price is going to speed up. If you are having trouble identifying where the lower resistance liquidity run is, where the imbalance price action is, where the generated liquidity is, this concept is perfect for you. Understand the market in terms of fuel like this. The market will speed up at areas of green and it will run through it all at once. The market will slow down or reverse at areas of red. That's how imbalances work. That's how all of this works. And this concept is simplified for anyone who doesn't understand the already existing concepts out there. So I hope these concepts will help your guys trading. If there's anything you're confused about, any questions you have, anything you want to go even deeper on, just drop a comment. I'll be the first to answer. And without further ado, I'm going to let you boys go. So peace out. Thank you guys for listening and have a good one.